very choppy right now as it's around this important level. Let's focus here on what happened on Friday. And we saw that we had this close. I'm looking at the daily time frame right now to show you the close below the 13,000 underneath a big technical break. When I say technical break, we could see if I zoom out over here to the beginning of 2001, we have 3 times, or we had 3 times, now we close below it, where price has held this support level, finally closing below. It's bad, it's worrisome. You know, the one great asterisk and caveat this week is that we have the FOMC, and you know, a 50 basis points rate hike is expected. Quantitative tightening going to be the headlines. It's more important how the markets react. I want to talk about what would negate this breakdown over here. When I say breakdown, price closing below 13,000. Right now, as it closed below 13,000, it's very weak. We're expecting some follow through, and it could be potentially a big leg down. Now, I don't think that Bitcoin is immune to pressure on risk on the equity markets or anything like that, but Bitcoin continues to hold above important support. We'll look at that in 1 second. George, 2 years today, CTM moderator. Lots of love to you too, and all the people of Lebanon. Thanks for being here. We appreciate that. Greetings from Happy May Day, Philip. Happy May Day. You know, glad that everyone is getting in over here. I want to take a look at some things. We're looking at April. This is the month of April, and we see that the 13%, right? This is, since Lehman, the biggest. April was the biggest monthly drop since Lehman. Markets right now, for sure, are under pressure. By the way, from January to April, it is the worst performance since World War II. Interesting. What is also interesting is that coming into January, for one day briefly, we just mentioned it. That and because what I was looking for was that Santa Claus rally effect. I was expecting some inflows into January. We did mention briefly that in the past, coming off such solid performance, that not only January, the first quarter, tended to have poor performance. We also know going into the first rate hiking cycle, the first rate hike of a new rate hike cycle, there's volatility around that rate hike, right? We've experienced all those things. What happens next, though? What happens next? You know, look, this is the only data that we have, but when you're looking at the S&P, right, the worst performance through 82 trading days, you know, this is going back almost 100 years. Again, this is the only data I have in front of me. But each time that's happened, you know, through the end of the year, well, it's been not quite positive. It's been really positive. Doesn't mean that this is going to repeat itself or anything like that. But I think it's really important to have that situational awareness. A year later, though, come back down to next April. Well, that's up in the air, isn't it? Now, a couple of other things. You're looking at Amazon putting in its worst drawdown since 2009. Jeff Bezos, by the way, he's been through some 95% drawdowns in his career. He's a hodler. He knows what it's like, you know. Now, this was during the hype phase of Amazon, right? Bitcoin's been through its hype phase, through its facing reality phase, you know. Couple of things before we get into the charts that I do want to continue talking about with you, right? We now have the buyback blackout period is over. That's bullish, okay? 10 more reasons why Goldman calls the end of the market carnage. Let's take a look. By the way, this is over here. This is not Goldman. This is JP Morgan. And JP Morgan, regardless of what's happening, is just bullish. Bullish at the top, bullish at the bottom. That's not really much help, is it? That's not much help. But that's not the same thing we're coming off of Goldman. Goldman actually was calling, right? Goldman was calling the big drawdown in April. They were talking about it, and now they're leaning bullish. So you know what? I think that we always talk about following those with a history of being correct. That doesn't mean getting everything right. That's impossible. But not everyone is right all the time. That's not what trading and investing is about whatsoever. Let's take a look. We got what's going on. We have U.S. corporations return back to the open window on Monday with dry powder. We are calculating $5 billion of demand per day until mid-June. What's also interesting about June, just a heads up and a caution for us, is that that's when the Treasury's liquidity is drying up. So it might not be sell in May, go away. By the way, what's to sell in May? Equity markets, Nasdaq down 20% in May, right? Sell in May, right? The S&P 500, what are we down? 12%. I'll check in a second. I'm not really sure. Two pensions flipped to buy, giving the recent performance of bonds versus stocks. Money market inflows logged a massive 600 billion inflows last week. Let me show you this one as well. Speaking of those inflows, you can see them over here visually returning to the market. And at the same time, let's talk about, just a little perspective. This is the S&P 500, right? Now, let's just call it 15%. We'll get the exact number in a little bit. And if you look at some previous nasty bear market moves, here's the dot-com bubble bust right over here in 2003, stopping about, 45% down. You could see that we got a potential long way to go. Here you're looking at the Great Depression, right? So just don't get too comfortable, or we're never comfortable here, are we? So let's talk about the upside, right? What would negate this bad technical breakdown that's occurring over here right now? Now, the question is what happens between now and Wednesday, right? Hopefully, the markets remain, as they often do around these times, in a holding pattern. It would make a lot of sense that people are not looking to take on new positions before the FOMC, right? Now, following the technicals, let me come down to the 8-hour just so we get a better view. I have over here this trend line break. This is a double black diamond. This would be the first indication. This would be the first indication that we are seeing this breakdown over here negated. So right now, call it above 13,450. Zoom out a little bit more. We got a nice conservative line of repair. Markets right now remain under correction for the foreseeable future. All right. Let's be on high alert, losing this area. I've showed you in the past couple of weeks what would happen potentially losing this after this rally, losing. By the way, this comes into exactly where the rate hike cycle started. This was peak war. Losing that level back, whether it was in 2000 or 2008, that led in 2008 to a much bigger leg down. It wound up being the last leg down. That was the bottom. But that was not what happened in 2000. It made multiple legs down afterwards. All right. I want everyone always to be to have that situational awareness of what they're facing. Let's take a look at the TNK, right? At the 10-year. And you can see that this over here, this sell impulse, Justin was all over this morning. You can see this sell impulse, right? Remember when it broke? We said we want to watch what happens. We want to watch and see if we see a waterfall down or if it's negated. We said it multiple times. It was negated. And you can see that over here. What do? Right? What we do when that happens is we go ahead and we redraw the trend line. We now have it like this. We'll continue watching. Is that signal? Is that a sign? It's not easy, only because of the market's reaction to what happens with the FOMC, right? It could go either way. It could be, most likely, what we're seeing is sell the rumor, and potentially it could be sell the news. The market is not liking the Fed's posture. The Fed is just unleashing into as the economy's headed towards a slowdown, towards recession, just unleashing this just really tough dynamic of tightening. And the market, in hearing that the Fed continues on that pace, it could just sell off. We're seeing breakdowns occur. Here's a breakdown occurring on Friday on the Nasdaq, right? It's very iffy. It's not looking very good yet. Now I pointed out the positives, right? Starting this off and talking about when you start a year off coming down this far, what's happened in the past. Gold is off today, right? If you look at some old school horizontal support and resistance, you can see these were drawn here year ago. You can see over there that nice breakdown, retest into that broken support, and then the resumption off as resistance. All right, here's a chart of real interest rates. We could see that you're looking at real rates beginning to rise upwards. Inflation here continuing to rise, right? And then over here, we're looking at the nominal interest rates, obviously, as they work towards hiking. I looked in the past. This is just only going back to 1974. I looked in the past when they were spread apart like this, like alligator jaws, and what happened. And you could see as the real interest began hooking up and rising, it's happening in these three periods: 1974, 1980, and then here in 2008, here even again. And we're seeing that hook lining. And if indeed we are seeing at the same time inflation putting in that near term peak, my expectations is that from the alligator jaws, we get more of that closed shut, right? And I do think that that's where we're headed right now. But it is possible that this time is different. It's possible that we are seeing a new paradigm shift in bond yields. But my own belief right now is that over the course of this year, we're going to continue to see real rates rise. Now, that's for now. And when I say that's for now, obviously my base case is the Fed is eventually going to pivot. And not only the Fed, also the government, right? And they're going to come out with more stimulus, further expansion of the balance sheet. And did real interest rates peak at 7%, -7%? That I don't think so. I do believe within these next, let's call it 10 years, that we see that substantially take out that low. Preston Fish talks about below -10% real interest rates. That's when we see the credit markets break and that tsunami of inflows into Bitcoin. But it's not always straight up and it's not always straight down. We'll keep an eye on it. And that brings us to, or what I'm really concerned about would be a breakdown over here of that channel, $35,000. You could see that over the weekend, low liquidity, right? We broke down below the bottom of this bear flag. We're currently trading above it right now, though. I think that is obviously no follow through, a little bit of noise. Even more importantly, as very clearly expressed, it's the 35,000, the break of the channel that I'm worried about. I think that brings in a quick test of the January low, and I don't think that holds, right? So is it fair to say that, the big test is going to be a little bit down further, the test of the summer lows? Most likely, if that all occurs. We're currently trading above the bear flag support right now. And the more important one, the level that we're watching, would be $35,000. All right, fam. Happy Monday. Thank you for putting in another important work session together. Bitcoin giving back its gains, not holding on to them, but we are seeing at the same time S&P under a little bit of pressure right now. I have to be honest, I'd rather see that pressure come at the beginning of the week rather than the markets floating into the FOMC and then trading off. We're just going to keep aware of the important levels that we're watching. And over here on the Nasdaq, we had that big breakdown that closed below 13,000. So we are watching what happens next. And that's why I want you to have the awareness of the repair line. Right now, we need to reclaim 13,450 for that breakdown to be negated. I don't want to alarm anyone. In order not to alarm you, I wanted to show you in the past what has happened, as we started the year off so bad. But going back into the 2008 and 2000, that's when we lost this particular point over here. And they did lead to further legs down.